How transformative is this for the industry?
This is the one I think that everybody's been waiting for. We've been talking for a long time about how the relaxation of the regulations for banking are going to affect banking and add to the consolidation. It's been a longer wait than
means they'll be allowed to be bigger.
Yes,
basically.
Yes. In fact, this transaction is a perfect example of that. They'll combine. Each of them were about to approach $250 billion in size, which would have triggered additional regulation. Together, they're going to be 400 and change. So they're at the same level that they would have been individually during that time. And so most people think that it's easier for them to contend with those additional expenses together than they would have had to do separately.
John, how much of it is also about going up against the behemoths? And I'm thinking of J.P. Morgan, Bank of America, Wells Fargo.
Well, everybody dreams about taking market share from Jamie.
Good luck with that, everybody.
Yeah, good luck with that, everybody. Of course, that's a big part of it. But to be frank,
but do they have to do it to compete, right?
They certainly do. And remember, you're just reporting about where interest rates are, and it's unlikely that rates are going to be moving up anytime soon. Bad news for banks in general, making it very difficult for any of us to see big improvements in revenue in the banking space, which leads inevitably to the fact that this is going to be a cost savings. Effort for the next year or two, and it's certainly combining institutions of this size adds to their ability to save costs in the back office.
So which regions do you feel have the most oversupply or ability to merge, and what are the companies with most exposure there?
That's a tough one. But I would say that if you look for the regions in the United States that are the slowest growing right now, that it would be logical that that'd be the region where you'd find opportunities like this. But you have to look at what size banks are in those regions. I would say the Northeast, there's an inevitability that there'd be consolidation in the Northeast, but not so much with super regionals. Remember, there's only a couple of those left, and everybody's talking about the same names this morning. But it's the mid-cap banks from 10 to 50 in size where I think the action's going to be. There's a lot more banks in that space. And remember that the $50 million, the $50 million cap on size is now $250 million with regard to additional regulations. So two $20 or $30 or $40 billion banks today could easily merge, form an $80 or $90 billion
still stay
bank,
well below
and
that.
still be well below the $250 billion.
I'm curious what kind of conversations are you having over at Carlyle when it comes to financial properties and banks, whether it's some of the smaller or the mid-size? Are you looking to make investments?
We're not looking at whole institutions, but we're certainly keenly focused on the financial industry in general. But the financial industry in general is a wide swath. It's not just banks, but it's fintech and it's anything that you can imagine having to do with banks.
Well, having said that, then what do you find most interesting when you look at the financial sector? As you mentioned, there's fintech. There's so many different ways to play it. So what do you find will be maybe the most interesting and longer-term investment opportunity?
I think that I really believe that this is a watershed transaction, and the consolidation in the mid-cap bank space is where the action is going to be. There's a lot of conversations that have been going on for the last year or two, and under the old regulatory regime, it was tough to imagine those things going down well. But the regulators have been much more open about the fact that well-conceived and properly executed transactions will be welcome. Listen, CEOs haven't missed the point that when this transaction was announced yesterday, both stocks were up.
Yeah, yes. That's what was interesting. Is it a merger of equals, though? Come on.
It is a merger of almost equals.
Close enough.
Yeah, it's close enough. It was a small premium deal, single-digit premium.
Okay.
Rather than a no premium deal. But remember, there were about 4 big premium deals announced over the last 2 years. Synovus the most recently, and then KeyBank with First Niagara. Those pretty well fell flat on their face with regard to investors. They did not go very well. So I think the attention now is going to be on very low premium deals. There was a time when mergers of equal was a curse. Nobody said that, right? Because that just meant everybody.
We never believed it as
Well, nobody
journalists.
believed it. And everybody always thought that just means everybody's brother-in-law gets a job, right? But frankly, these guys are, these are two pretty sharp guys. They know each other well. They trust each other. Not their first rodeo. They've been around a long time. They know the risk they've taken by stepping up and projecting what they think their earnings will be. By the way, that $1.6 billion if I were them, I'd be sandbagging a little bit. I'll bet they're going to do better than that, and I think that this is going to prove to be a very good transaction.
That was a big number in just a few years. I was pretty impressed with that in cost savings through 2020. Talk about the Midwest for a second, because that's where we see just a lot of the banks, right? You have Fifth Third, Huntington, Key Corp. Like, what areas are just overbanked?
Well, you named it. I mean, that nest of banks right in the Midwest is certainly something to pay a lot of attention to, in addition to the Northeast. The TCF deal about 10 days ago, TCF and Chemical Banks, smaller banks, 20-somethings getting together, forming a 40-something. Most of us thought that was indicative of the beginning of something hot going to happen. Nobody expected BB&T deal so quickly on the heels of that. But I think that's what you're going to see. Look, there's strain on bank managers to produce earnings now, with interest rates where they are, and the inability to improve revenue is widespread and acknowledged. And most of us think that the economies are going to slow, and something has to be done.
I mean, what is the biggest challenge for the financial sector? Because I do think about when bank earnings came out, right? They weren't terrible. We talked about a record year, I think it was, for revenues, and yet some of them got beat up in terms of investors. Well,
people are looking forward and imagining that the best news for banking is behind us. The income tax reduction is behind us. Interest rates are flat to down. Generally speaking, bad news for banks. So. I think that's probably the reason.
Forward-looking.
What about underlying demand? Because a senior loan officer survey this week said that loan demand was just not there right now. Are banks having a harder time competing with each other and for demand, or is it also shadow banking and other forms of funding that actually is becoming their bigger competitor?
Both. Banks are certainly competing vigorously in the loan side as loan demand declines in most areas of the country. Again, adding to the logic behind a transaction like this and others that I think will follow.